Hey there, Benjamin Carter with Lensure Financial. Want to ask you a question. Is a no-cost loan really a no-cost loan? As you probably have heard in the news, we are in the middle of a refinance boom with mortgage rates hitting new record lows. Ever since they've been keeping track of where mortgage rates fall, they've never seen mortgage rates come down this low. So hopefully, if you haven't done so already, you're in the process of researching your refinance options. And as you're researching, I want you to especially pay attention to the costs and benefits of your loan. Let's go back to my original question. What really is a no-cost loan? Well, talking about the costs and benefits, if your bank calls you up and says, hey, we want to give you a 4.5% interest rate instead of your current 5%, keep your loan balance the same, that gives you a new payment of $2,026. We're going to save you $121 a month. You're going to think that's fantastic. And then they're going to close that sale by telling you there's no cost. You don't have to pay a dime to do that refinance. Some of us may be scratching our heads and saying, but there's always a cost of doing business. And there are always costs. When you're doing a refinance, you have a loan origination underwriting fee, appraisal fee, title insurance, escrow, prepaid taxes, and insurance. So who's exactly going to be paying for these costs? The answer is you will be paying for these costs. And let me show you how you would do that. So in your current example, you're going to be refinancing, but here are the real costs. These are typical underwriting and other closing costs that you, the borrower, would be paying. Those would total $67.75. Okay, and so looking again at what lenders will offer you, they have credits that the lender gives to incentivize them to give higher interest rates. And in this case, a 3.875 with this lender gives you a $500 credit. And we move on, you can see that that lender credit increases the higher the interest rate they try to sell you on. And as you can see, at a 4.5% interest rate, there's a sufficient lender credit to cover all of your closing costs. And so that's the loan that they're going to be selling you, so that there's no cost. But as we know, the cost really is just passed on to you in the form of a higher interest rate and higher payment. So back to our original example, they're trying to sell you on 121-month savings, but what if you looked at all of your options? And let's take, for example, a 3.875 interest rate with the $500 credit. Your total out of pocket is $62.75, and we move down the line. You can see the out of pocket decreases as your interest rate increases. So does it make sense to pay money out of pocket during a refinance? Well, the best way to do is let's compare. A 3.875 instead of a 4.5 gives you a payment of $18.80. Now that payment saves you $266 a month as opposed to what the 4.5 saved you, which was only $121 a month. So let's compare the 4.5 to the 3.875. Obviously there's a greater cost, $62.75, but there's also better savings. And so you take those two numbers, the cost difference and the savings difference, and we do a little bit of math. We divide those two, and that shows us that in 43.27 months or 3.6 years, the extra cost that you would spend to get the 3.875 is counterbalanced by your savings, and in 3.6 years, you would be breaking even. Now that really makes sense, I think, to break even at that point. And yes, if you're going to be in the home for 3.6 years, you would want to do the 3.875. Now the good news with all of this about what's a no-cost loan is I'm always going to show you all the options. A no-cost loan all the way down to you pay money to close that loan. But as you can see in the examples here, it makes a lot of sense to go with a lower interest rate and pay some money out of pocket, because in the long run you will win. I hope that all helps. Please give me a call for a quote where I will show you every single option and you can choose what works best for your family. Have a great day.